As of February 28th, 2025, the Nifty 50 is down by 16% from its one-year high of September 26, 2024, which is also its all-time high. During this period, the other major indices are down between 17 and 25%. Naturally, investors are looking for cover to protect their portfolios. Now, in this video, we will tell you about funds that fall less when the markets slide. Are we going to talk about hybrid funds whose debt component cushions their fall? No, we aren't going to talk about them. So are we going to talk about large cap equity funds that tend to fall comparatively less than the other equity categories? No again. We are going to talk about funds that fall less within the comparatively more volatile equity categories where containing the downside is really important. Hello and welcome to ET Money's YouTube channel. If you're looking for a safe pair of hands amid the ongoing volatility, this video is going to be immensely useful to you. But to get the most out of it, you must watch it completely. But before we begin, a quick disclaimer. The funds we are going to discuss are not our recommendations. The idea is to highlight their superior downside protection abilities. So do your own research before investing in any of them. Now this video belongs to our playlist on fund trends. If you'd like to watch more such videos, do explore this playlist. The link is in the description. Okay, let's first talk about how we pick these funds. As hinted earlier, our objective of this video was to pick funds that fall less within the comparatively more volatile equity categories that have or can have a high mid and small cap allocation. So, we selected 5 market cap based equity fund categories: small cap, mid cap, multi cap, large and mid cap, and flexi cap. The first 4 have a mandated exposure to mid and small caps, and the 5th has a go anywhere mandate that can result in a high mid small cap exposure. Now in the next step, we picked a benchmark for each of them. For small cap funds, the benchmark considered was the Nifty Smallcap 250 index. For mid caps, the Nifty Midcap 250 index. For multi caps, the Nifty 500 Multicap 50-25-25 index. For large and mid caps, the Nifty Large Midcap 250 index. And for the flexi caps, the Nifty 500 index. Of course, we consider the TRI variant for all. In the third step for each category, we picked funds that did better than the benchmark amid the recent correction, that is between September 26, 2024 and February 28, 2025. Yes, we know the correction may not be over yet, but for our purposes, we considered February 28, 2025 to be the terminal date. Now in the fourth step, we selected funds whose average 3-year rolling returns since January 1, 2018 were higher than those of benchmark and the category. Now this helped us select well-performing funds from the lot. To be sure, our purpose was to discover funds that fall less but not at the cost of poor to average overall performance. So selecting funds that did well in terms of rolling returns helped us pick the winners. But why January 2018? Well, since fund mandates changed and intra-house reshuffling happened at many AMCs post SEBI's reclassification exercise in 2017, doing so helped us consider funds that are truly comparable. Since multi-cap funds came into being only in 2021, for them, we have considered the period from January 1st, 2021. Now, if you are wondering why are we considering average 3-year rolling returns and not any other duration, here's our logic. Considering this duration gave us sufficiently high data points to make a reliable conclusion. If we considered, say, average 5-year rolling returns, many funds would have been out of this research due to the insufficient history. Also, we would have fewer data points. Any duration less than 3 years would have been too short for judging performance. So we didn't consider durations like 1 year or 2 years. That said, do know that you must have a horizon of at least 7 years when investing in equities. Never invest in equities for durations less than that. Okay. So once we had the well-performing funds across all categories, we went on to calculate their downside protection ratios. Let me explain this to you. The downside protection ratio tells us how well a fund contains its downside versus the benchmark. A higher ratio indicates better downside protection and vice versa. And how did we calculate the downside protection ratio? Well, since January 2018, we have considered all negative monthly returns of the benchmark and checked the fund's corresponding returns in those months. We then calculated the percentage of times a fund beat the benchmark. and that became the downside protection ratio for that fund. We also did something similar in an earlier video where we examined why containing the downside is more important than participating in the upside for long-term outperformance. You can watch that video later. I have included the link in the description. Okay, in the final step we picked funds whose downside protection ratio was 80% or more. Now this implies that over 80% of the times these funds fell less when their respective benchmark gave a negative return in a month. To summarize, this methodology helps us achieve quite a few objectives. First, we got funds that have done better than their benchmarks in the recent bear run. Second, these funds are also good overall performers as they are ahead not just of their respective benchmark but also the category in terms of their average 3-year rolling returns. Third, their recent downside protection is not a one-off as they have demonstrated superior downside protection abilities in the past too, as determined by their downside protection ratios. All in all, we got a list of robust funds that can weather any market storm and keep your portfolio safer when stocks are falling like 9 pins. Okay, let's now examine in detail each of the steps we followed and how we arrived at the final list. As we saw at the start of this video, the markets have been trending lower since September 26, 2024 when they hit a peak. The table on your screen summarizes the performance of the funds in the selected categories. Based on the benchmarks considered, all the categories except the small cap category reflect a wide divide between the outperformers and the underperformers. In the mid cap category, about half the funds failed to beat the benchmark. Among flexi caps, about 44% of funds failed to do so. Now, in the case of large and mid cap funds, a third failed to impress. And in the case of multi cap funds, 30% of funds didn't beat the benchmark. Now, the difference between the average returns of outperformers and the benchmark range from 1.6 to 3.1 percentage points. Next, let's analyze the rolling returns of the outperformers versus those of benchmark and the category. As discussed, we compared the average 3-year rolling returns of the outperformers with those of the benchmark and the category average. The table on your screen summarizes the outcome. At this stage, the number of funds was further filtered. Only 11 of the 23 eligible small cap funds cleared the criteria. In the case of mid caps, this number was 8. In the case of multi caps 3, larger mid caps 8, and flexi caps 7. The average outperformance over the benchmark range from 1 percentage point to 8 percentage points. Over the category, the average outperformance was 1.2 to 4.1 percentage points. Now, for the funds that beat both the benchmark and the category, we calculated the downside protection ratios. Let's take a look at them in the next section. As we discussed, we calculated the downside protection ratio by checking in how many months starting January 2018 a fund beat the benchmark when the benchmark gave negative monthly returns. For multi-cap funds, the starting month was January 2021. Now, see the table on your screen. For small cap funds, the outperformers have an average downside protection ratio of 81%. As many as 6 funds have a downside protection ratio of over 80%. The average downside protection ratio of the mid-cap and the multi-cap outperformers is in the 70s, but just a couple of funds have a ratio over 80%. Large and mid-cap, and flexi-cap funds have the lowest downside protection ratios in this set. Just one fund each in these categories has a ratio of over 80%. In all, just 11 funds have a downside protection ratio of over 80% in these 5 categories. We started with 153 eligible funds and have now reduced the list down to just 11 funds. Now, to further trim the list of small cap funds, we decided to pick the top 3 funds in terms of the rolling return performance and downside protection. This actually gave us 4 small cap funds since there was a tie between 2 funds. So what are these 9 funds? We will see in the concluding section of this video. I'm sure you're excited about these 9 funds, but before that, do subscribe to this channel and hit the bell icon so you never miss a video from us. Here are the 9 funds that cleared this rigorous research framework and emerged as winners. The 4 small cap funds that have appeared in the final list include those from Axis, Edelweiss, Nippon and Tata. Among these, Axis Small Cap Fund has done the best in the recent correction. it contained the loss to 19% against the benchmark's 25%. In terms of the average 3-year rolling returns, Nippon India Small Cap Fund is at the top among the final small cap funds. Its average returns stand at handsome 33% per annum. Now, in terms of the downside protection ratio, Axis Small Cap Fund is the star with a 92% beat rate. Only one mid-cap fund made it to the final list, SDFC Mid-Cap Opportunities. The fund limited the recent losses to 16% as against the benchmark's 21%. But the fund's average 3-year rolling returns are only slightly higher than the benchmark and the category returns. Its downside protection ratio is 81%. Now, two multi-cap funds have appeared in the final list, ICICI Prudential Multi-Cap and Nippon India Multi-Cap. At 29% per annum, Nippon India Multi-Cap's average 3-year rolling returns are really remarkable. At 82%, both the funds have the same downside protection ratio. Now, only one large and mid-cap fund was able to make it to the final list. It's Kotak Equity Opportunities Fund. Its performance is only slightly better than the benchmark and the category, but its downside protection ratio stands at a good 81%. Now, the ultimate leader in the pack in terms of recent performance is Parag Parekh flexi-cap fund. The fund has fallen just 7% in the recent market correction against the Nifty 500's 19%. Its average 3-year rolling returns are ahead of the benchmark and the category by multiple percentage points. And of course, the fund does a great job at containing the downside too, with its downside protection ratio of 82%. Now, if you'd like to know more about these funds, we have covered a few of them in our earlier videos. You can check our playlist on fund analysis and comparisons. The link is in the description. Now, you can very well consider these 9 funds for your portfolio, but don't forget to do your own research. Remember, we aren't recommending this to you. And with this, I've come to the end of this video. I hope you found it useful, and if you did, please share it with your friends and family. I'll be back soon with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.